Credit fundamentals. South Africa's BB- rating is constrained by low real GDP growth, a high level of poverty and inequality, a high government debt-to-GDP ratio, and a rigid fiscal structure that hampers deficit reduction. The ratings are supported by a favorable debt structure with long maturities and mostly local currency denominated, strong institutions, and a credible monetary policy framework. Weak GDP growth. We forecast low real GDP growth of 0.9% in 2024, 1.5% in 2025, and 1.3% in 2026, against 0.7% in 2023. This compares with our BB median forecast of 3.2% in 2024, 3.6% in 2025, and 3.5% in 2026. Growth is hampered by a struggling logistics sector, deeply entrenched structural factors, particularly high levels of inequality, poverty, and unemployment, and weak investment. We expect the weakness to persist, despite robust demographics. Electricity shortages, which dragged on growth in 2022 and 2023, are expected to ease, but sporadic incidents of load shedding could still occur. Weak GDP growth. Progress on reforms, moderate impact. The authorities have continued to implement the 35 priority reforms under Operation Vulindlela, launched in 2020, which aim to modernize network industries, including electricity, water, and transport. We expect the Government of National Unity, in which the African National Congress is the largest party, to continue the reform program, which will contribute to a modestly increasing real GDP growth. However, we do not think the reforms will significantly raise South Africa's low growth potential, which we estimate at 1%. Political uncertainty eases. The formation of the Government of National Unity following the May 2024 general elections lowers short-term policy uncertainty. We consider the ANC and DA broadly aligned on key priorities, particularly on the growth-enhancing agenda. Nevertheless, risks to political stability remain, with some topics, such as foreign policy, social grants, and the national health insurance, potentially contentious. Risks are exacerbated by South Africa's exceptional level of social inequality. Moderate fiscal consolidation. We forecast a consolidated fiscal deficit of 4.7% in the fiscal year ending March 2025, Fitch defined financial year 24, broadly unchanged from 4.8% in financial year 23. We forecast this to be followed by fiscal deficits of 4.2% in financial year 25 and 4.0% in 26, driven by a moderation of general public service and transfer expenditure. Fiscal flexibility is hampered by a rigid fiscal structure, with wages and interest payments representing 49% of total expenditure in financial year 24. In our forecasts, we expect revenue to remain at around 27% of GDP over the next 3 fiscal years. Risks to our forecasts are balanced, with wages and the National Health Insurance Bill, if implemented, posing upside risks to our expenditure forecast, while stronger GDP growth could boost revenue. High government debt. We forecast consolidated government debt to continue to rise to 76% of GDP in financial year 2024, 77.8% in financial year 2025, and 78.0% in financial year 26. Well above the 2024 BB median of 55%. This is a slower pace than we anticipated in our January 2024 review, as the government plans to withdraw 150 billion rand, or 2% of estimated financial year 2024 GDP over financial years 24 to 26 from the Gold and Foreign Exchange Contingency Reserve account. The account balance was 507.3 billion rands in January 2024. The temporarily reduced pace of debt accumulation does not affect our assessment that debt and GDP will not durably stabilize over the medium term. Favorable debt structure. High contingent liabilities. The debt structure has long maturities of over 10 years for total debt and a low share of foreign currency denominated debt. South Africa's contingent liabilities remain high, with a government guarantee exposure to public institutions, independent power producers, and public-private partnerships of 629.6 billion rands in March 2024, which is 8.9% of financial year 23 GDP. Struggling logistics sector. Likely support. the state-owned freight transport and logistics company Transnet remains hampered by rolling stock shortages, theft, vandalism, and years of underinvestment and mismanagement. The 18-month recovery plan, announced in October 2023, enabled a small increase in rail and container volume. However, its net loss has reached 7.3 billion rands, which is 0.1% of financial year 23 GDP, and its financial sustainability is constrained by high leverage. We believe further government support is likely, and we have penciled in a 50 billion rands below-the-line support in our debt projection, split between financial year 24 and 25. Inflation pressure eases. Headline inflation eased to 4.6% in July 2024, close to the middle of the 4.5% target. We expect further moderation as food and oil prices continue on their slowdown, and forecast inflation to drop to 4.5% by end 2024 and 4.0% in 2025 and 2026. In recent months, the South African Reserve Bank has expressed its desire to replace its inflation target by a point target of 3%. We believe there is still room for rate cuts under the revised target, for which we expect a formal announcement and approval by early 2025. Rising current account deficit. We forecast South Africa's current account deficit to widen to 2.4% of GDP in 2024, from 1.6% in 2023, and stabilize at 2.6% in 2025 and 2026. We expect import growth to outpace export growth, with rising domestic demand fueled by the relaxation of energy constraints and lower policy uncertainty. We anticipate an increase in net portfolio investments, which, combined with still strong net foreign direct investment inflows, would stabilize SARB's international reserves at 4.9 months of current external payments, against a BB median of 4.5 months. Financing resilience. The fully flexible exchange rate regime, the South African rand's high liquidity in international markets, the strong domestic fund management industry, and high share of local currency in government debt help insulate the sovereign from external shocks. ESG. Governance. South Africa has an ESG relevance score, RS, of 5 for both political stability and rights and for the rule of law, institutional and regulatory quality and control of corruption. These scores reflect the high weight that the World Bank Governance Indicators, WBGI, have in our proprietary sovereign rating model. South Africa has a medium WBGI ranking at 46.7, reflecting a strong level of rights for participation in the political process, moderate institutional capacity, established rule of law, and a moderate level of corruption.